Earlier this week, we've had a lot of Fed governors come out and say they're maintaining rates. What happens to the market if rates are maintained? We've talked about the CME tool multiple times, and the market has been expecting cuts, in the near future.
Yeah, just to recap, the CME tools, the Fed Watch tool, it is the place to go. You can type in CME, Fed Watch tool, and see what they've got in there. It's pretty interesting. We've presented a few times on the show. And what it does is it shows the futures markets and what the bet is for the next rate change, next meeting, actually. And so, at the beginning of the year, the CME tool showed that the market was expecting 6 rate cuts of a quarter point each, right, starting in March. And the Federal Reserve put out their dot plot at the end of the year, said they're going to do 3 rate cuts, basically quarter point. So kind of half. And so the Fed governor's been coming out, over and over and saying, hey, we're not seeing, that many rate cuts that soon, right?
Yep.
And honestly, I'm not either. I'm not sure why the market feels that's going to happen. And so now we're seeing that back off, right? And I actually talked about that in my daily videos this week, that, it's possible we could see no rate cut for the year, right? Where it just stays.
And there's some fear associated with that because, the Fed has, in the past, held rates too low for too long or, had them high for too long. So it's a bit of a, trying to find that Goldilocks zone, that just right temperature.
Yeah, of course, the problem the Fed has is that it takes time for these changes to hit. So by the time things are falling apart, if they're lowering rates then, it's probably too late.
Yeah.
And we're going to end up with more pain than we should. And if you go to the other side, inflation was already happening pretty drastically, and they weren't raising rates. And they were calling it transitionary, remember, at the time? It became a bad word. And obviously that didn't turn out to be true. So this is the same Federal Reserve that didn't raise rates fast enough that now could leave them, up too long.
But there's some examples, like I think, was it 2019, where they were raising rates and they held it and the market kind of came back after that.
Yes.
So, they can do it at times, too.
Yeah, exactly. The weird thing is, if they don't change rates for 2024, it means that there's no recession happening, which is good. And it means there's no inflation happening, which is good. It means we're right in the middle of the zone. Now, maybe that creates a problem for 2025 or beyond because they didn't lower rates fast enough. But I don't see that as being a terrible thing either. And where we are right now with rates at around 5.25, 5.5, that's a very reasonable rate. Because this is the big deal. You've got to understand that when rates get too high, the stock market really struggles. If you can go out and get 10% in a 10-year, treasury, why would you buy the stock market, which averages about 11%, right? Right now, 10-year treasuries, 4.5-ish versus 11. People are going to go to the stock market. That's why we're seeing some run here. So it can stay here at this level for as long as it wants, as far as I'm concerned. However, it does create some other problems because, one of the reasons we've had an okay recovery, as it turns out, and there's several studies done at the end of last year, is because businesses refinanced during the downturn. And so, they got just like the rest of us did with our mortgages and what have you, right? And so we're not, my mortgage is at 2 3/4. I'm insulated from the increases. But as new homeowners go out to buy, right, it's a higher. As businesses need new debt, it's higher. And so it can have a long-term impact, right?
Yeah.
And so that's what the market's going to be looking at. But I think the rate cut deal, to me, what's important is they're not raising rates and we're not seeing inflation jump back up.
Yeah, and the crazy part is, in years past, markets have been successful at this 5 and 5.5% interest rates. It's really when they're kind of raising rates is when we run into issues.
Yeah, and the best 5 years in the history of the stock market from 95 to 2000, I remember 6% Fed rate. In that time frame, they were raising rates. I think they raised rates 19 times actually. In that time frame, and eventually they got up so high that it broke everything, and they irrational exuberance that they were worried about disappeared in a 45% market drop. So that in essence is not happening here, at least at the moment. The rate. That's why the market has taken off since the end of October, because the rates are not increasing at this point in time, and they can stay there. I think the market does okay. Yeah, we'll see what happens to the economy in that environment, but could be fine. This is not a bad rate level to be at. I do think the average long term is around 6%. I can't remember that for sure, but it's right in there. So, being at the average rate increase, the markets have been fantastic for, a long, long, long time, really, especially over the long term.